Hey everyone, welcome back to Corporate Decoder, the place where we decode the confusing language of corporate finance. And in this filing, it looks like Runway Growth Finance Corp is getting ready for a pretty big shake-up. Today we're diving into a document that lays out a major merger. And trust me, there are some interesting details hidden in here about how they're planning to join forces and what it means for everyone involved. Before we get started, make sure you're subscribed to the channel for more of these breakdowns. And if you want to connect with fellow investors and dive deeper into these topics, we have a Discord community linked in the description below. This Form 8K filing is essentially a big announcement about a significant corporate event, and in this case, it is all about a planned merger. Runway Growth Finance Corp, or Runway as it is often called, is planning to merge with SWK Holdings Corporation, or SWK. So, what exactly is this merger agreement? Picture this as a multi-step dance. First, a few subsidiary companies are set up. Then SWK will merge with one of these subsidiaries. And immediately after, that combined entity will merge with another subsidiary. The final step is that this merged entity will then merge with RWA itself. The end goal is for RWAY to be the sole survivor owning everything from the merger. Why all these steps? Well, sometimes it's for tax reasons or to manage liabilities, but in plain English, it's a structured way to combine the two companies. Now, let's talk about what the shareholders of SWK get out of this. They have a choice. They can either receive newly issued shares of Runway common stock, or they can opt for cash. On top of that, regardless of whether they choose stock or cash, they'll also receive a portion of a fixed amount of cash, which is $9 million divided by the number of SEP shares outstanding. This looks like an incentive to get the deal done. The value of these shares and cash payouts will depend on something called the determination date. This is a date set just a couple of days before the merger officially closes. On that date, both RWAY and SWK will calculate their net asset value per share, the exchange ratio which determines how many WA shares someone gets for their SWK shares will be based on these net asset values. This is a crucial point because if the net asset values change significantly between the time this agreement is signed and that determination date, it could impact the value of what SWK shareholders receive. They've also built in a mechanism to reevaluate these values if the merger is delayed. Of course, in any big deal like this, there are always outs. The agreement includes standard termination rights for both RWAY and SWK. One of the key conditions for this deal to go through is that the SWK shareholders need to vote and approve the merger, and they're not going to move forward unless that approval happens. The companies have also made a bunch of promises called representations, warranties, and covenants. These are basically assurances that everything they've told each other is true, and they promise to do certain things leading up to the merger, like using their best efforts to make it happen, running their businesses normally, and cooperating on filing necessary paperwork. Think of it as the pre-marriage counseling for these two companies. The actual closing of the merger also has a few more hurdles. Both sides need to ensure their promises hold up, meaning their representations and warranties are accurate, and they've followed through on their obligations for SUAK. There is also a condition that a third-party valuation firm's estimate of their portfolio assets can be more than $5 million less than SUAK, S-own calculated value of those assets. This seems like a way to protect SWK shareholders if the company S-own valuation is overly optimistic. Now, here is a really interesting piece. There is a separate agreement called the Key Stockholder Agreement, and it's with a major shareholder of Sublease Quake, the shareholder. Double Black Diamond Offshore Limited owns about 70% of Sublease Quake stock. What's critical here is that this key shareholder has agreed to vote their shares in favor of the merger. This is often a make or break element in getting approval for major deals, but it doesn't stop there. The Key Stockholder Agreement also places some pretty strict limitations on what this major shareholder can do. They've agreed not to solicit proxies or consents for alternative deals related to RWAY, or try to get the investment advisor of RWAY fired or have its agreement changed. Essentially, they are locking themselves in and agreeing not to disrupt RWAY's operations or leadership while this merger is pending. This is a strong indicator of their commitment to the deal. It is also worth noting that SWK board took action to make sure that Delaware's anti-takeover laws wouldn't block this merger. As with most of these filings, to raise a section on forward-looking statements. This is basically a disclaimer warning that the future projections in this document involve risks and uncertainties. Things like the ability to actually close the merger, the expected benefits like cost savings, potential competing offers, and whether all the conditions can be met are all listed as potential roadblocks. It is essentially saying, we hope this works, but a lot could go wrong. They are also telling investors and shareholders where to find more detailed information. This includes a registration statement on Form N-14, which will contain a proxy statement and prospectus. This is where all the really fine print will be, and shareholders will be able to get these documents for free directly from the SECS website or from the company's websites. This part is a heads up that certain executives and directors from both RWAY and SWK might be considered participants in the process of soliciting proxy votes for this merger. It is a standard disclosure to ensure transparency about who might be influencing the shareholders' decisions. And finally, this section lists the actual documents that are being filed along with this report. The most important ones here are the agreement and plan of merger and the key stockholder agreement. These are the blueprints for the entire deal. Now, let's shift gears and look at what this all means. This merger between RWAY and SWK appears to be a significant strategic move. RWAY, which is a finance company, is looking to expand or consolidate by acquiring SWK. The fact that a major shareholder of SWK is so heavily backing this deal, agreeing to vote their substantial stake in favour, and even agreeing not to pursue other options, signals strong conviction from that shareholder. The structure of the merger, with multiple steps and choices for SWK. Shareholders tells us they're trying to be flexible to get the deal approved and to ensure fair value. The conditions tied to the merger, especially the one involving the independent valuation of SWK's assets, are designed to prevent a situation where SWK shareholders feel they are selling their company for less than it is truly worth. This is a good sign for shareholder protection within the deal's framework. One of the biggest risks, as highlighted in the forward-looking statements, is simply the execution risk. Mergers are complex and there is always a chance they derail. The success of this deal will hinge on navigating regulatory approvals, shareholder votes, and any unforeseen complications. The inclusion of the key stockholder agreement significantly de-risks the shareholder approval aspect for RWA, which is a major positive. Looking at their market position, RWAY is a specialty finance company, and SWK Holdings is in the business of providing financing and acquisition solutions to the healthcare and life sciences industries. This suggests RWAY might be looking to gain a stronger foothold or diversified exposure in the healthcare sector through this acquisition. The success of combined entity will heavily depend on their ability to integrate operations and realize the synergies that RWA is surely anticipating. In conclusion, this filing details a well-structured merger with strong shareholder support from a key stakeholder. The focus on valuation and clear contractual obligations suggests a calculated approach. The main challenges will be in the execution and integration of the two companies, but the commitment outlined in these agreements makes this a significant development for both RWAY and SWK. Alright, that is our breakdown of this merger filing. What do you think about this deal? Does it make strategic sense? Drop all your thoughts in the comments below. If you found this analysis helpful, hitting that like button really helps us out, and subscribe for more corporate decoding. And don't forget to join our Discord community in the description to keep the conversation going. Thanks for watching, see you next time.